Today, we will talk about stock market investing for beginners. What is the stock market? Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own a majority of the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Where does stock come from? Public companies issue stock so that they can fund their businesses. Investors who think the business will prosper in the future buy those stock issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investment shrink or disappear entirely if the company runs out of money. How to start investing in stocks. 8 tips for beginners. 1. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. When you start looking at statistics, you've got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual. So it's a very difficult game for the individual to win over time, says Dan Keaty, CFP, Chief Financial Planning Strategist at TIAA. If you're analyzing a company, you'll want to look at a company's fundamentals, earnings per share, EPS, or a price-earnings ratio, for example. But you'll have to do so much more. Analyze the company's management team, evaluate its competitive advantages, and study its financials, including its balance sheet and income statement. Even these items are just the start. Kitty says going out and buying stock in your favorite product or company isn't the right way to go about investing. Also, don't put too much faith in past performance because it's no guarantee of the future. You'll have to study the company and anticipate what's coming next, a tough job in good times. 2. Avoid individual stocks if you're a beginner. What they forget about is that often they're not talking about those particular investments that they also own that did very poorly over time, Kitty says. So sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market. And sometimes they confuse luck with skill. You can get lucky sometimes by picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. 3. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund. For example, if you own a broadly diversified fund based on the S&P 500, you'll own stocks in hundreds of companies across many different industries. But you could also buy a narrowly diversified fund focused on 1 or 2 industries. Diversification is important because it reduces the risk of any one stock in the portfolio, hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. 4. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk. Try how you might. 5. Try a stock market simulator before investing real money. One way to enter the world of investing without taking risks is to use a stock simulator. Using an online trading account with virtual dollars won't put your real money at risk. You'll also be able to determine how you would react if this really were the money that you gained or lost. That can be really helpful because it can help people overcome the belief that they're smarter than the market, that they can always pick the best stocks, always buy and sell in the market at the right time, Kitty says. 6. Stay committed to your long-term portfolio. Kitty says investing should be a long-term activity. He also says you should divorce yourself from the daily news cycle. By skipping the daily financial news, you'll be able to develop patience which you'll need if you want to stay in the investing game for the long term. It's also useful to look at your portfolio infrequently so that you don't become too unnerved or too elated. These are great tips for beginners who have yet to manage their emotions when investing. 7. Start now. Choosing the perfect opportunity to jump in and invest in the stock market typically doesn't work well. Nobody knows with 100% certainty the best time to get in. Investing is meant to be a long-term activity. There is no perfect time to start. One of the core points with investing is not just to think about it, but to get started, Kitty says. And start now. Because if you invest now, and often over time, that compounding is the thing that can really drive your results. If you want to invest, it's very important to actually get started and have an ongoing savings program so that we can reach our goals over time. 8. Avoid short-term trading. Understanding whether you're investing for the long-term future or the short term can also help determine your strategy and whether you should be investing at all. Sometimes, short-term investors can have unrealistic expectations about growing their money. And research shows that most short-term investors, such as day traders, lose money. You're competing against high-powered investors and well-programmed computers that may better understand the market. New investors need to be aware that buying and selling stocks frequently can get expensive. It can create taxes and other fees, even if a broker's headline trading commission is zero. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.